Hello and welcome to our latest update on the cost of living, and also increasingly looking at the state of the sort of changing markets. So today we have invited Freddie from our property consulting team, who's going to join us and share his insights. So welcome, Freddie. And yeah, since we last met, there has been a huge amount of change. Wage growth has actually picked up. So tell us what this means in your view.
Before we get into it, I was going to caveat all of my views are very much learned and borrowed from much more clever people, and I've been very much sitting on the fence throughout it all. I think we've seen so much change over the last few years, and so much of it unprecedented. We now also have the significant uncertainty of the Middle East, that everything that I'm about to be talking through and giving my or others' views on, it may well move in a completely new direction again.
No, fair point.
Yeah, but coming back to your wages question, yeah, I think there's some very exciting news. And I remember being asked 12 months ago by a client of, will we be able to see people afford this rise in inflation, the continued rise in inflation? So it is great that we're now seeing that wages are catching up with inflation again, and that hopefully it will halt, if not grow, that fall in consumer confidence that we've seen over the last few months, allow people to make more purchases, afford repayments on credit cards or mortgages, etc. But I think it very much needs to be caveated and looked at in sort of a wider macroeconomic concept. The government hasn't changed its tax thresholds, so that's meant that since 2021 we've seen 2 million more taxpayers, generally across the UK, and 1.3 million more people move into the higher tax rate. So whilst people may be thinking, great, I've seen this gross rise in wages of, I think we've seen over 8% on average at the moment, in reality, what is going into people's pockets post-tax, national insurance contribution, etc., isn't going to be to that same extent. And in fact, the Resolution Foundation expects that the income for a typical working age household will be 4% lower in 2024 than it was in 2021. So we're not out of the woods yet in terms of meeting that rise in inflation. And in fact, there's almost a worry that if that inflation growth remains very sticky, and we see that over 8% continued growth in wages, that core inflation is going to be pushed back up. Business will effectively be looking to tap into that to grow their squeezed profit margins from the last few years again, and again forcing the Bank of England Monetary Policy Committee to raise interest rates again, and we get back into this cycle that we've seen over the last 2 months, again caveated by we've now got the increased global uncertainty as well.
On that topic of interest rates, obviously at the moment, at least, they've seemed to have at least partially stabilised. We've been talking a lot in the past about how that's impacting people's mortgages. Are we in a better position even at the moment? Are people going to feel benefits at the moment?
It's a really interesting question. Again, I think everyone got quite excited when we saw that pause in the rise in the inflation rates, Bank of England following what was the US Federal Reserve in holding those rates. And there is a lot of speculation that interest rates have now peaked, and we're starting to see that lag between interest rate changes and inflation start to occur. Inflation dropping back down again, especially that core inflation. And there is, when you look at the minutes from the Monetary Policy Committee, that a lot of those members now want to pause those repeated rises, let the interest rates bed into the new interest rates bed into the economy. They are still at over 5%, obviously very significant interest rates. So yes, whilst a pause is positive, let's not remember how high they actually are. And then we've got the added challenge, difficulty, I suppose, to speak, or unknown, perhaps a better term, of that many mortgage holders, so about a third of the UK have a mortgage, are on fixed rates and won't have seen the full impact yet of the rise in interest rates.
So yeah, it's a fair point. So yeah, so you've got a load of people that, even though mortgage rates may not continue to rise, it's a load of people who are still going to see a rise in their interest rates because they're coming from a set fixed lower base.
Yeah, exactly. They may at the moment, in reality, their interest rates, they fixed a term in 5 years ago, they're at 2-3%. However, with 1.6 million deals up to expire by next year, they're suddenly going to see this big jump in what they're paying. If you think about what that could mean for households, so if we're renewing at sort of 6%, that's going to attract an extra £795 a month. If it's at 5%, it could be a further £587 a month that people are paying on their mortgages. So it's not insignificant levels that we're talking about at that point. I think there is a riposte that people could make, but we're actually seeing interest rates on mortgages be below the Bank of England's base rate of 5.25%. For example, I saw yesterday a deal at 4.85%. So you look at that on paper and think that's great. However, these lower than Bank of England base rates mortgages are often on very long-term fixed terms. So that 4.85% example I talked about expanded for 6 years, or was fixed, sorry, for 6 years. So the lender is effectively gambling and betting on interest rates, with the Bank of England's interest rates coming down below that. So in reality, if you're taking up that 4.85% mortgage, you're going to be having higher repayments over a longer term. Your income is going to be squeezed over that longer term as well. And that obviously is going to have impact on our clients as well, of what does that mean in terms of how much are people going to be afford to spend over a sort of a medium to longer term.
But I guess if we clutch at some small positives here, it's good to hear that some lenders are at least speculating, albeit over that long time window, that mortgages are getting at the interest rates.
Yeah, it shows a level of optimism from them, doesn't it?
Yeah, exactly.
But it's assuming that the lenders are always hedging, then it's not going to be for 3 or 4 years that they're saying that the rates are going to go down to that level. So I guess we're at a slightly more positive place on interest rates, but I think
that hits.
It's a journey.
That hits the nail on the head, and it's with a lot of this, and is on the one hand you can see positives coming through on it, and I think there are green shoots of recovery, of optimism to be had throughout it all. But let's not get carried away yet, and we need to continue to think about, right, how can we ensure that we can continue to drive turnovers, drive revenues for as retailers or as landlords.
Yeah. Okay. Which brings us to there's been new sales figures out since we last met. What are they telling us at the moment? Because they seem to have given a fairly mixed message.
I think that hits the nail on the head. Again, as with everything, we've got a mixed messages coming through. So August, there was this surprising jump, a surprising rise in the volume of retail sales. And I'm going to talk volumes of retail sales, not total sales, because of the level of inflation that it still continues to push up how much people are actually spending. So August, rise in volume of sales, though it's just been reported that September we actually saw a bigger drop than was expected. I think a 0.2% drop was widely expected across by economists. However, we think we saw it at 0.9% drop. And actually, when you look at non-food retail sales volumes, that drops by 1.9%. But in this time, I've actually almost got a positive to spin onto it, and that a lot of that can be attributed to the warmer weather that we saw in early September, our Indian summer that we saw. And so as a result, people didn't need to be purchasing warmer clothes as we moved into autumn. They could continue to keep their shorts out for a longer period of time. And it will be interesting to see as we move into October, November. Now we have the storms coming. Actually, does that delayed spend come back and effectively move from September into October into November, and then obviously we move into the Christmas peak at that point. So hopefully we get to see some positive figures moving forward.
I expect there's quite a lot of retailers sitting on a lot of winter stock, having to make a decision about whether to stick or twist, whether to discount or to hold full price. And then there is a risk in there that someone jumps on discounting and then you get a spiral.
Yeah, I think very much so. And then we're starting to look at all our proverbs about what does rain by this date, etc. mean before we can make a decision on that. I'll leave that to the meteorologist who's doing the next podcast.
Actually, Pitch just completely stitched up Hannah, who is doing the next podcast and isn't doing meteorology. So actually, that's a good link to Hannah. What are you going to talk about next month?
Given we're talking about Christmas, we're doing another Christmas survey with, again, speaking to the general population of the UK about how they're feeling. We ran a really similar exercise last year, where we basically talked to consumers about how excited they were about Christmas, how they were expecting their spend to change to kind of react to the mounting pressures. It was the first real Christmas where we had kind of headlines all around the energy crisis. So we saw really stark results in terms of what people were anticipating that they would do in order to save money. We saw a lot of concern, for example, amongst young people aged under 25, saying they didn't think they were going to go out very much over Christmas to try and save that money. So we're running a very, very similar exercise this time around. And fingers crossed we get some interesting results, but also fingers crossed consumers are slightly less worried than they were last year, but that's all to be seen.
It's interesting you say that, Hannah, just jumping back in again, that with people wanting to save money, etc., but we've also seen a rise in the amount of outstanding on credit cards. So it's been a 21% increase since March 2021, of having seen the lows at that time following the COVID period. And that is very much not equally split. And it's those sort of thriving neighbourhoods, our younger, affluent households who are often driving that on as they see, coming back to my housing point that I was talking about before, the greatest squeeze on their incomes because of mortgage repayments and rent increasing as well. And it'll be interesting to see, you may well talk about it next time, but what that then means in terms of how people are behaving and what they're spending on. So is it going to be fewer luxuries, a shift to cheaper products, etc.?
Yeah, absolutely. The other thing that we're tackling this year that we didn't tackle last year, we're talking to consumers just before Black Friday. So it's going to be really interesting to know whether Black Friday is now a more appealing prospect, because we know that the popularity of it has slightly diminished the last 5 years since its peak, probably back in 2017 or thereabouts. Are people now going to try and use it to save money? Do people think it still saves them money? So that's going to be really interesting as well.
Yeah. What I think is, again, just thinking broader as well, is we've seen the continued success of outlet centres, for example, over the first half of this year, and there's been a lot of talk about London Designer Outlet, and they've reported very strong sales figures as well. And does that all link into this desire to hunt out a bargain? But at the same time, people not buying luxury, so are they going to be on a targeted bargain hunt? And if they can't find it, they pause it rather than buying something else that they don't necessarily need. So it might be that Black Friday means a slight shift in how people approach it. It's not the manic rush in, let's grab the nearest electrical that it was once. And it's, if I can find it, great. If not, I'll find it elsewhere, hopefully.
Just at risk of asking you a question, building on what you just talked about in terms of outlet centres and things, do you have any view? Is some of that international travellers, because the pound is so cheap relatively at the moment, and obviously COVID is less in the forefront? Has that driven some of the growth this year?
Oh, there's got to be a case of that international travel. When you look at the tourist figures are returning to where they were pre-pandemic. But you, again, even once you use our transactional spend data to dive into who it is that's actually driving it on, you can still see that growth coming out of UK residents as well. And again, returning to our thriving neighbourhoods that I referenced before, a lot of them driving that performance on. Then, as we said, disposable income, discretionary income being squeezed, and therefore pivoting away from perhaps some of the full price to moving towards more of an outlet shop.
Just touching on that tourism point, I saw a stat from the European Tourism Council, and London was the most visited city in Europe last year. And a lot of the reasoning behind that was people thought, apparently a huge proportion of that was US tourists that were coming and taking advantage of the fact that the dollar is particularly strong versus the pound at the moment. So we're definitely seeing that.
Yeah. Okay. Thanks for that. Now, Freddie, we got you here. It wouldn't be fair to let you go without asking the tricky question of, so what's your view? Summarize where you think we're heading. Are we in a good place, bad place, better place, worse place?
A very good question. I remember once being told that the first law of economics was that for every economist even, there exists an equal and opposite economist. So there, I think you could almost go down the line of there's two approaches that you could take on it. There is, as we talked about, this potential for an uplift going forward. We've seen interest rates hopefully peak. We've seen inflation coming down. People's wages is coming back to match those rises in prices, etc., allowing people to spend more. However, for each of those positives, there's an argument that watch out what could be about to around the corner. If those wage growth continues to stay too high, does that drive inflation back up? Interest rates, yes, the Bank of England's rates have increased and hopefully peaked, but for 1.3 million households, we're about to see that interest rate impact hit. And I think there is some, the economy will start to improve. People will get more confident again. There is this talk that by 2025, we should be back at the Bank of England's inflation target of 2%. But that is happening in 2025. It's not happening November 2023. It's not happening 2024. It's still a long way off.
Okay. No, thank you for that. And we'll put a note in our diaries, Hannah, invite Freddie back in 2025 and see if he got it right.
I've hopefully caveated my answer enough that if I'm not right, I can point out why I wasn't.
Like all good economists.
Yeah,
okay.
Yeah.
No, thank you. It's been great to have you here. And hope that you've enjoyed the podcast today. And we look forward to catching up with you next month. Thank you.
Thanks.